Hi there, Chuck Gibson from Financial Perspectives in Pleasanton, California. Today on my monthly market recap, I'm going to look at a few noteworthy charts of September market action. Let's get right to it. My first chart is a quick look at the monthly, quarterly, and year-to-date returns. This current correction has dramatically changed the 2015 data, as now every asset, except for bonds, are in the red for the year. And while bonds are higher, they are up only slightly so, just at 1%. Through the end of the third quarter, a balanced, diversified world portfolio consisting of 50% stocks and 50% bonds is down just under 7%. If we're going to turn this around and follow the typical third-year presidential seasonal positive return cycle, the fourth quarter will need to be a barn burner. My next chart is a year-to-date look at stock returns around the world. The two items that stand out most are that every region is down for the year, averaging about a 10% loss. Secondly, and most significantly, the Chinese Shanghai Index in blue rose like a phoenix from the ashes starting in March, climbing more than 60% over a 3-month period, and then came crashing down to below where it started the year, 2 months later. For those that have not witnessed a parabolic rise and blow off, this is a classic example of an emotionally driven market. Notice how it works the same going up as it does going down. As an investor, it's hard to make money during parabolic runs, as time horizons are typically much longer than the rise and fall lasts. If you are a trader, on the other hand, this is how fortunes can be made in a very short period of time. Either way, they are spectacular to observe and have comfort knowing that they will continue to repeat time and again as they have since the markets have been in existence. My next chart is a daily view of the S&P 500. In the US, the first half of September was spent chopping higher, creating the B leg of an ABC corrective pattern I mentioned in last month's video. Once that leg terminated, the market again sold off hard, similar to how it acted in the A leg. This is what you expect with ABC corrections. The A and C legs are usually violent and fast, while the B legs are very choppy, with their length typically extending to 50 to 61.8% of the A leg. Right now, the question we need answered is if the C leg is complete, or is there further downside? Regardless, once it is complete, I expect to see a healthy rally that will likely run for weeks or months, with the potential to test all-time highs. Whether it makes it or not, only time will tell. But in the meantime, I see the bulk of this current correction is behind us, with the possibility of one more push down setting up for an ideal divergent low entry likely. Historical seasonal patterns point to an end of this correction somewhere in the middle of October. Before we move on to my next chart, I want to point out a couple of major changes that have developed. Both the death cross, which is the 50-day moving average crossing under the 200-day moving average, and the slope of the 200-day moving average has changed from positive to negative, which are typically very bearish signals. It's important to note this is the first time that both of these have occurred simultaneously during this entire bull run from the 2009 market bottom. This, folks, is something that raises a huge warning flag, and when considered in conjunction with the rest of the data I'm going to show you, is very disconcerting. This next chart is a weekly look back at the S&P 500. What I wanted to show here are what other corrections during this bull run have looked like and why this one is different. Ignoring the first correction I have highlighted in blue at the bottom left-hand corner, you can see as you climb the price stair from bottom to top, every correction has essentially been V-shaped. That is, up until the current one. What I mean by V-shape is that there's a quick decline followed by a similarly quick recovery. While the current correction is not over, we can look to the first correction in the bottom left-hand corner for a clue on what path the current one will likely take. The main difference between the first one and the subsequent V-shaped ones is rather than having a singular bottom, the first one initially bottomed and then retested that level many times before it finally moved on to new highs. The reason is because of the overhead supply of the sellers. The more sellers there are, the longer it takes for the buyers to absorb that supply of shares. Each of the V bottoms had very little overhead supply, so it was quick and easy for the bulls to move prices higher. I want to point out this week ended with a hammer candlestick at almost the exact same level the other hammer candlestick that occurred 5 weeks ago. While there are no guarantees, This is additional information that the low of this week has strong support, and it could turn out to be the bottom when we're able to look back in the rearview mirror at the current correction. I'm going to spend the rest of my time left in this video on my final chart. As investors, the best way to win over the long haul is to stay with the trend and avoid the bulk of major downturns. Note, I didn't say avoid all major downturns because no one can time the market exactly. What I believe can be done, though, is what I stated, avoiding the bulk of major downturns. I have, over the years of analyzing thousands of charts, developed a set of indicators and systems that, when combined together as a whole, do just that. This 20-year monthly chart of the S&P 500 is very busy and will take some time to explain. I usually try and keep my charts that I present in these videos as clutter-free as possible in order to make them more understandable to the viewer. But in this case, I have combined as many of the long-term timing indicators into one place. In the upper pane is price momentum. Ideally, we want momentum to be flat or rising if prices are to move higher. So if momentum starts to weaken and begins to fall, this is a warning that prices may soon follow suit. In the middle pane is the monthly price movement of the index indicated with brown candlesticks and includes two moving averages. The 2.5-month moving average is in green, but it's hard to see as it is hidden behind the candlesticks. The 12-month moving average line is in red. A crossover of the faster 2.5-month under the 12-month is a bearish warning and provides a simple systemic exit signal. I have highlighted where cross-unders have occurred with a blue circle because it's kind of hard to tell otherwise. You can see in the prior two market tops in 2000 and 2008, this crossover system did a good job at identifying a time for investors to get out of the market. It didn't pick the top, but it did do exactly what long-term investors desire, which is avoid a major part of the following drawdown. In the third pane from the top is the price momentum oscillator, PMO, which measures the rate of change of price. This too can be used as a simple standalone system to identify market tops because once the smooth blue moving average crosses under the slower red one, it identifies a good time for investors to shun market risk. I have identified the past crossover periods with a red circle and blue vertical line since it may be hard to see otherwise. If you follow that point up to the S&P 500 pane above, you can see, like all indicators, it's not perfect, and it's sometimes early and other times late, but in general does a very good job of identifying and avoiding the largest chunk of major drawdowns. Finally, in the bottom pane is another indicator, the MACD. Very similar to the PMO in its action and measurement, when its faster green moving average line crosses under the red slower one, an exit signal is given. Again, in an attempt to make it easier to identify, I have highlighted the crossovers with a red circle and this time used a green vertical line. Like the PMO, the MACD has provided very good long-term exit signals in the past. What you should notice is that regardless of the indicator, all of them provided at least one false signal. False signals are part and parcel to timing systems. This is the reason I employ many indicators and wait for confirmation of all of them in an attempt to increase their probability of success and reduce those false signals. My proprietary indicator, which I have not included in this chart, triggered an exit back on August 31st, but employs a whipsaw filter that requires a weekly close below 1903.7 to confirm, which has not yet occurred. Finally, the oldest and arguably most famous Dow 30 sell signal triggered earlier this year. When looking at the weight of the evidence, is there any question as to why I'm extremely cautious right now? Tops are a process and take time. Unfortunately, no one rings a bell to let you know it happened. You'll only know by looking backwards in time at some point in the future. And at that time, it will seem so obvious and plain as day. But while you're in it, living through all the wiggles up and down, there is nothing clear about it, as the signals are very mixed. But from my perspective, in looking at the weight of the evidence, I am leaning heavily on the side of a market top is likely in place, but not before a seasonal year-end rally occurs. But I have learned over the years, the market has a way of proving the majority of its participants wrong. For that reason, I'm extremely cautious right now, but watching closely for signals to the contrary. Those signals will be determined by one thing only, and that's price. Indicators are great and are best to be used to confirm price, not replace it. People mistakenly think it's all about beating the market when it's trending higher. That's extremely hard to do consistently and without leverage. The fact is, I stated earlier, investment managers' outperformance comes from minimizing drawdowns during the severe downturns. Regardless of whether this turns out to be a top or just a correction, we continue to execute our process, which is set up to stay involved in uptrends and reduce portfolio exposure as risks increase. Hopefully this analysis provides some insight as to our actions over the past few months and why we have your portfolios positioned as we do. That's it for this month's video. Have a great October and stay prepared for continued volatility. As always, I appreciate your time and attention and hope you have found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next month, this has been Chuck Gibson from Financial Perspectives with the September monthly market recap.